Every government insists its currency is secure. Every Treasury Secretary claims the system is solid. And every time, they're concealing the boldest financial maneuver ever invented. The United States doesn't merely print money when it needs funds. It executes a shell game. So smooth, so flawlessly coordinated, that most people never realize they're watching the most impressive economic illusion ever performed. The move itself is simple: America purchases its own debt. And why this matters goes far beyond academic theory. It's the underlying framework propping up everything you believe about money. When people picture government borrowing, they imagine foreign lenders or wealthy investors snapping up treasury bonds, China stockpiling U.S. debt, pension funds seeking safe returns, banks holding reserves in government notes. That's part of the narrative, but not the entire truth. The full reality is stranger, more cyclical, and far more dangerous than anyone wants to accept. Hidden deep inside the Federal Reserve's balance sheet lies a truth that would condemn any other institution for fraud. The U.S. government doesn't simply borrow money, it manufactures the very money it later lends to itself. Here's how this illusion is carried out. When Congress chooses to spend more than it collects in taxes, the Treasury issues bonds. These serve as IOUs, promises to repay the borrowed amount with interest. In theory, investors purchase these bonds, exchanging actual cash for future payments. But there's a catch. Sometimes there aren't enough buyers willing to absorb the government's supply of debt. Sometimes interest rates would need to climb so high they'd crush the economy. Sometimes demand for government bonds simply falls short. That's when the Federal Reserve intervenes. The Fed, officially independent but practically inseparable from the Treasury, creates new money out of thin air and uses it to buy government bonds. No investors required, no genuine savings needed. Just digital numbers entered into a computer that instantly convert debt into currency. The government issues a bond, the Fed buys that bond, and money appears where none had existed before. Consider the mechanics. The Treasury claims it needs $1 billion. It prints a bond promising repayment plus interest. The Federal Reserve accepts the bond and delivers $1 billion newly created dollars. The Treasury now has spending money, and the Fed holds a promise of future repayment. But here's the crucial detail: both entities are ultimately controlled by the same government. It's like writing yourself a check and then depositing it into your own account. This isn't speculation. It's official policy that occurs daily. The Federal Reserve's balance sheet, which anyone can check, lists trillions in government securities. These aren't bonds purchased from private investors. They're instruments acquired directly or indirectly from the Treasury using money that didn't exist until the Fed created it. This is the most advanced form of money printing ever designed, disguised as ordinary market activity. The scale is staggering. During the 2008 financial crisis, the Fed's balance sheet surged from under $1 trillion to over $4 trillion. During the COVID era, it expanded again, reaching nearly 9 trillion. Each jump represented new money created to buy government debt, mortgage securities, and corporate assets. Each time, the justification was emergency intervention. Each time, the result was identical: more money chasing the same amount of goods, services, and assets. But the bond mechanism goes far beyond crises. It has become the default mode of operation. When the government finances defense, infrastructure, or social programs, it doesn't rely on tax revenues. It issues bonds, knowing the Federal Reserve will step in if investors don't. This forms a feedback cycle where spending drives borrowing. Borrowing drives money creation, and money creation fuels further spending. The genius of the system is that it appears legitimate. The Federal Reserve maintains the appearance of independence. Rules prohibit direct bond purchases from the Treasury. Procedures make it seem like market forces are in control. But remove the layers of bureaucracy, and the truth is obvious. One branch of government is lending money to another branch using funds it creates specifically for that purpose. This matters because it destroys the natural relationship between earning and spending that governs every business and household on earth. A company wanting to expand must save profits or attract investors. A family wanting a home must save a down payment or qualify for a loan. But the government can spend at will by issuing bonds that are bought with newly manufactured currency. The impact spreads across the economy. When the Federal Reserve creates money to purchase bonds, that money enters the banking system and becomes the base for new loans. Banks lend against these reserves, multiplying the new money. What began as digital entries on the Fed's books becomes mortgages, car loans, credit lines, and business funding everywhere. This explains why asset values skyrocketed while wages barely moved. Why housing prices soared beyond affordability. Why stock markets hit records while small businesses struggled. New money flows first to those closest to the financial system, inflating the value of assets they already own, while everyone else faces rising prices and diluted currency. The bond system isn't merely an accounting maneuver, it's a mechanism of wealth redistribution that shifts value from savers to borrowers, from workers to asset holders, from the future to the present. And because most people don't grasp the process, they have no defense against its consequences. Defenders of the system insist it's essential. They argue modern economies are too complex for simple, spend only what you earn rules. They cite theories claiming money creation is a tool for guiding growth and preventing deflation. They argue that without this flexibility, governments couldn't handle crises or fund vital services. But these arguments overlook a core truth: the system survives only as long as people trust it. And that trust is eroding. When Americans watch their savings lose value while billionaires grow richer, they're seeing this mechanism at work. When families can't afford homes their parents easily purchased, they're feeling the impact of decades of money creation. When retirees see their pensions shrink in purchasing power, they're discovering what happens when currency becomes a political instrument instead of a store of value. The global dimension makes the situation even more perilous. For years, foreign governments have willingly participated in America's bond cycle. They hold trillions in U.S. treasuries, effectively lending their wealth to support American spending. But this arrangement exists only because the dollar remains the world's reserve currency. Nations require dollars for oil, trade settlement, and financial reserves. What happens if that changes? What occurs when major economies decide they no longer want to finance American deficits? What happens when the Fed's balance sheet becomes so massive that even allied nations begin doubting whether their bonds will be repaid in money retaining real value? At that point, America's ability to buy its own debt transforms from a domestic trick into a global risk that could explode spectacularly. China already sees this. Russia learned through sanctions. Other nations are quietly developing alternative payment networks, exploring digital currencies, and reducing dependence on dollar-based assets. They're not acting out of hostility. They're acting because they realize any system allowing one country to create money to buy its own debt gives that country enormous leverage over everyone else forced to use that currency. The math behind the bond system cannot hold forever. Every bond purchased with new money increases the debt load while devaluing the currency used to repay it. As debt rises, more bonds are needed. As more bonds are issued, more money must be created. As more money enters the system, each dollar loses purchasing power, requiring even more borrowing to maintain government spending. This self-reinforcing cycle accelerates during crises when the Federal Reserve abandons any pretense of restraint and directly monetizes federal spending. The COVID response demonstrated this perfectly. Congress authorized trillions in spending. The Treasury issued bonds. The Federal Reserve created money to buy them. The process moved so rapidly that private investors had no chance to absorb the debt even if they had wanted to. But the most damaging effect of the bond mechanism isn't financial, it's social. When money can be conjured at will to fund political agendas, the link between taxation and representation collapses. Politicians can promise costly programs without raising taxes, knowing the Federal Reserve will fill the gap. Voters can demand services without experiencing the immediate cost, since inflation spreads it across all holders of the currency. This produces a dangerous loop where both leaders and citizens lose touch with economic reality. Spending becomes detached from earning. Promises detach from resources. The political structure begins operating as though money is infinite, even though real resources are not. The bond machinery has turned America into a financial illusionist, performing the same trick repeatedly, each time with higher stakes and an increasingly wary audience. The government writes itself checks. The Federal Reserve cashes them. And everyone pretends this is normal. Monetary policy instead of the most intricate financial illusion ever devised. But every illusion is revealed. Eventually. And when this one collapses, it won't be only the magician who pays the price, it will be everyone who believed their money represented real value. Understanding this system isn't just about economics. It's about knowing that your savings, your income, and your future are being subtly redistributed through a process most people never notice.